setting up your company for Wave is to review the chart of accounts and clean it up. When you created your Wave account, Wave automatically created a chart of accounts for you based on the type of industry that you're in and the type of company that you are. But just because it set up a default chart of accounts with those generalities doesn't mean that it's necessarily the right chart of accounts for you. There are going to be always some specifics that you'll want to modify depending on what you're particularly interested in your company. Now, cleaning up the chart of accounts is something that you'll ideally want to do when you first create your company file, but even if you've been running in Wave for some time, it's still something you can do right now, and it's something that I would highly recommend. Before we jump into cleaning up the chart of accounts, I first want to help you understand exactly what accounts are and how they're organized inside Wave. That will help us understand, as we're selecting different types of accounts, where exactly we should put them so that they show up right in your accounting reporting. So first of all, what is an account? An account is essentially a categorization to help you organize your transactions in such a way that it makes it easier for you to analyze and identify important trends to your company. Basically, accounts are a label to help you know where money is and how it got there. So before we can even dive into cleaning up your chart of accounts, we're going to want to understand, first of all, what kinds of trends and analysis is important to you as a business owner. Obviously, that's going to depend very specifically on your particular business. The types of trends that are important for, say, a dog grooming business is going to be different than perhaps a product sales company or a marketing consulting company. Every industry is going to have some unique trends that are important for that industry to understand in order to know whether or not the company is successful. Also, as a business owner, you have a better pulse on your business than anyone else. Perhaps there are certain areas that you're particularly interested in that are unique to you in the way that you manage a business. So before we even dive into doing your chart of account cleanup, we first want to understand what kinds of trends are important to you and your business so that we make sure that we set up your accounts in such a way that you'll be able to easily access that information. So before we get started, take just a few minutes to think about what kinds of trends you want to understand. These can be things like understanding your costs related to selling your product versus your costs related to running and operating your business. Also, you might be interested in, say, the top 5 largest expenses for your company. If your largest expenses are, for example, your employees, your payroll expenses, then you're going to want to know how those payroll expenses trend over time. Also, you may want to understand what the percentage of those total payroll expenses are comparative to your sales. So you want to be able to track those very closely. Maybe in your business you've had difficulties in the past maintaining your travel costs. So you want to focus on those travel costs and make sure that they're not trending too high. Typically, areas that you tend to focus on more carefully are expenses that vary over time. You know, your utilities, your rent, those are typically the same amount month after month. But things like travel or payroll expenses can fluctuate depending on certain seasons or certain issues that are happening within your company. So those are areas that you typically want to track very closely. So understand what kinds of expenses you incur as a company. You know, understand what kinds of revenue you have coming in. And how do you want to track it? Do you want to track your revenue as just one lump sum? Or do you have certain regions or certain offices that you want to track separately, or certain product lines maybe, that you want to track the revenue of one versus the other a little more closely? So understanding these kinds of trends and analysis can help you in setting up your chart of accounts. So get a feel for a few minutes of what kinds of things are important for you to know in your business in order to make better management decisions. Write those down and set those aside as you're working on your chart of account cleanup, so you make sure that each of those areas that are important to you are reflected in the accounts that you're creating. Once you have that brief analysis put together, then we can start talking about creating those accounts that are going to help you analyze those particular areas. Now, like most accounting software packages, Wave groups its accounts according to the reports that you're going to be running in the software. The most common reports to run in order to do analysis on your company are the income statement and the balance sheet. So your accounts are grouped according to those categories. So Understanding how your accounts are structured requires you to understand what these reports are and what they're trying to accomplish. Let's first start by looking at the income statement. So if you've ever run a family budget before, then an income statement is going to look very familiar to you. Like a family budget, the income statement's purpose is to help you track your expenses and understand whether or not your company is earning or losing money. So, like a family budget, we'll begin with our cash in, which is called revenue. We'll subtract out all of our cash out, our expenses, and what's left over represents your savings or your losses. These are typically called your net profits or your net losses. Now, what does differentiate an income statement from, say, a personal budget is how the expenses are split out. There's an additional categorization for expenses that's very specific to the business world. Expenses in a business are typically split up between costs of goods sold and operating expenses. So costs of goods sold are any kinds of costs that are related to the sale of your product or services. Sometimes these are called variable costs because typically these costs will vary depending on how many products or services are sold. The more products and services that are sold, the more higher these expenses are going to be. The less items that you sell, the lower these costs are going to be. So sometimes we call these variable costs. Sometimes they'll also be called direct costs because these are any costs that are directly related to the sale of that product or service. So some examples of costs of goods sold would be product costs. So if you're in an industry that sells products, the cost it takes to buy those products. Also any commissions that you might give to your salespeople for selling the products, or any merchant's account fees, your credit card fees when you're selling. So anything that's related to actually selling the product is a cost of goods sold. My rule of thumb is, theoretically speaking, if you don't sell any product this month, will you still incur that cost? If the answer is no, or not probably, then this is most likely a cost of goods sold. However, if you're going to incur that cost anyway, and it's going to be about the same regardless of whether you sell any product this month or not, then that may not be a cost of goods sold. Your operating expenses are any expenses that are related to the operation of your company itself. These are costs that are incurred simply to keep the door open and the lights on, regardless of how many people walk through the door. So, oftentimes we'll call these fixed costs because, unlike the cost of goods sold, they don't vary depending on how many products are sold. Regardless of if you make any sales or not, the costs for operating your business should typically remain the same. They can also be called indirect costs as opposed to direct costs because these are not directly related to the sale of your product or service. Examples of operating expenses would include things like rent, utilities, advertising costs, professional service costs like paying your accountant. These are things that you're typically going to pay a regular amount every month regardless of whether you're selling anything. So, in your income statement, you've got 3 basic categorizations for your accounts, or groupings for your accounts. And those are your revenues, all of your cash inflows, your sales, and then COGS, all of your expenses directly related to the sale of your product or service, and your operating expenses, all of those fixed expenses that are related to just managing and operating your company. Now, your other account groupings that we're going to worry about today are going to be related to your balance sheet. So let's jump over to the balance sheet and take a look at what that looks like in a way. So a balance sheet is divided into 3 basic groupings: assets, liabilities, and equity. If you've ever purchased a home before, then these groupings should be somewhat familiar to you. When you purchase a home, if you want to understand what your value of the home is, you take the total market value of your home, subtract out the cost of your mortgage, and what's left over is the amount that belongs to you, which is called equity. The same is true in the business world. If you want to understand what the worth of your company is to you today, you take the market value of your company, which are your total assets, all of your property, all of the belongings of the company. You subtract out all of your debts, called liabilities, and what's left over is your equity, the amount that belongs to you. So some examples of some assets would be things like your bank accounts, any kind of cash that you own, investments, also your accounts receivables, which are the amounts owed to you by your customers, and also any kinds of assets, fixed assets, property that you own, such as machinery, equipment, vehicles. Those would all be considered assets. So your liabilities would be any kind of a debt that's incurred by the business. These could be things like business credit cards, any kinds of outstanding bills called accounts payable, or long-term debts, small business loans, things like that. The equity section, as we mentioned before, represents the value of the company to you. This section is automatically created when you set up your Wave account and entered in your business type. So as long as you entered in the business type correctly, this section is probably just fine and will need very little, if any, updating by you. If you're concerned about whether or not the equity section is set up correctly, I would highly recommend having your CPA or tax accountant review it with you, because they will understand exactly what this section needs to contain and can help you get it set up correctly. But as I said before, most likely this section's already set up just fine, provided that you've done the setup correctly when you created your Wave account. Now, as you may have noticed, this section includes the net profits from your income statement, as well as something called retained earnings. The net profits section represents all of the net profits for the company for the current year that the balance sheet is printed. That's because these net profits essentially belong to the owner. Any net profits from prior years are going to be contained in that retained earnings section. These are the earnings or the profits from previous years that are retained in the company to be able to grow and develop the company. Thus they're called retained earnings. So these are the basic groupings of the balance sheet: assets, liabilities, and equity. You can be more specific if you want. You'll notice that in this example, assets and liabilities are divided into current and long-term. Current is typically anything that is going to be resolved within a year or less. So any kinds of receivables that you anticipate receiving in full in a year or less can be put into the current section. Cash is typically a current asset. Your accounts receivables are typically current assets. Liabilities is the same thing. If you plan on paying off the entire loan within a year or less, such as maybe a credit card or a bill, those would be considered current liabilities. But anything that you plan on paying off in a longer time period than a year will typically go in long-term liabilities. You'll see this definition of current and long-term come up in just a few minutes as we begin creating accounts inside of Wave's chart of accounts. So you'll want to keep that definition in mind. So now that we understand our groupings for our chart of accounts, we're now ready to start looking at what your chart of accounts looks like in Wave and doing some initial cleanup. We'll be deleting some old accounts, changing some names, and creating some new accounts to really specialize your chart of accounts to your specific interests and needs for your business.
Thank you for watching the Bootstrapper's Guide to Wave Accounting. If you found this video useful, I encourage you to click the like button below, subscribe to our YouTube channel, and share this video with other entrepreneurs. Doing so will help us to continue creating more videos like this one for you and other Wave users here on the Accounting Lab.